Hi everyone, so let's now take a look at Learning Aim A's different types of savings and investment. This is our second lesson on this, so let's get stuck in. Right, first up we're going to start with bonds and gilts. I've just made a note here that the UK government has a national debt of £1.7 trillion as at April 2018. Now, really what this means is that they need to finance that borrowing. They need to finance it by selling bonds. Okay, so bonds are just government debt. And in return for people buying bonds, people get a fixed return. So perhaps 2% interest for the duration of that bond. Okay, and that bond may last 10 years. Okay, so they're fixed term investments where the lender lends money to companies and governments in return for interest payments. Okay, so this gives you a fixed regular return. It also spreads your risk across different markets. Bond markets are generally seen as that bit safer as a form of investment. However, some governments have previously defaulted on their bonds, their government debt. For instance, in 1998 in the Russian economy, Russia just said, no, we're not paying anyone, too bad. And a lot of investors lost a lot of money. So yes, generally speaking though, if you invest in a Western economy, then you're going to get a relatively safe investment, but that means you won't get too high an interest rate. If you want a bit more risk, well, you could invest in the corrupt government that has been in place in South Africa, or you could invest in Venezuela, and there you might find returns of 10% or so, but of course a lot more risk. Okay, so yes, there is a risk of losing some or all of the value of the investment if the bond price falls. Okay, so that can be bad news. Interest payments may not be received if the borrower defaults on the money as well. Okay, so yeah, there's two downsides really, but because there's bond markets, if you bought £100 bond and suddenly the market is scared that the government isn't going to be able to pay back all of their borrowing, that £100 bond might suddenly crash in value to just £50. Okay, you're right. So let's move it on. Shares. So when it comes to shares, this is an investment in a business in return for equity and a share of the future profits. Okay, so it's just a tiny proportion of the overall company's ownership. Okay, very small proportion. So it does offer you voting rights on the company and appointment of board of directors and so on. Okay, there's the potential for high rewards, and that is because your share price may rise in value. If you bought shares at £3 and they go up to £5 each, then if you've bought 1,000 of those shares, you've done pretty nicely there. Okay, there's also the potential for a split of that profits, a share of those future profits, all otherwise known as dividend payments. And so you can receive dividend payments each year as well. And there's also the possibility for discounts. So for instance, with Brewdog, when Brewdog had a share sale recently, they were offering discounts when you actually visited their bars, say like 10% or so, I believe. Now, this is a higher risk form of investment. Very much depends on the how the company performs. If the company does well, the share price goes up, and vice versa. There's no guarantee of any reward, and if the company went bust in the worst case scenario, then you might even lose all of your money. Okay, so then finally we've got pensions here. So these are long-term savings plans where individuals make regular contributions throughout their working life. It encourages saving, of course, throughout your life, so that's really beneficial. It means you know you're thinking about your retirement. Payments are often deducted at source as well, so you never actually see that money, and that forces that commitment on individuals to think about the future. Okay, so that can be an advantage, could also be a disadvantage too. The final outcome can be difficult to actually predict though, and there's a variety of reasons for that. So for instance, pension companies will often invest in share and bond markets, and it really depends how well their investments have gone here. So they've taken your money and they've put it into the share or stock market or the bond market, and if these markets have tanked, well, this is going to be bad news for your pension. Okay, there's also a movement between jobs which may actually impact on the total amount you actually put in. So it may take time between stopping and restarting any pension investment program. Okay, that's nice and straightforward. So out of these savings and investment products, which is your favourite? Did you love the premium bonds? Was that the one that really got your going, or what was it? I'm just curious. Let me know in the comments down below. All right, thanks guys.